For more, let's bring in Joe Lavorgna, counselor to the Secretary of the Treasury Department. Joe, great to have you with us. Do you agree with that sentiment?
I do. I mean, the thing is, the GDP numbers, which we could get into, were fantastic. It was all private sector led. But what struck me, Melissa, is the profound weakness in the interest-sensitive sectors of the economy, such as structures and residential. Structures, which are factories. By the way, they'll get a huge lift with the tax bill. 2026 should be great. But we've had 7 quarters in a row where structures investment declined, 3 quarters in a row where residential investments declined. And that certainly is interest-sensitive related. So, yes, the economy is booming. I still think the potential of the economy is excellent, as the president said, and 2026 should be a banner year given these current trends we're seeing.
So if the economy is booming, Joe, why is there a need to hand out $2,000 stimulus checks, and why is there the need to cut interest rates? If the economy is booming, shouldn't we be concerned about inflation?
Well, yes, inflation is certainly an issue. It rose to a 40-year high under the prior administration. But what we're seeing, Melissa, this is really a CapEx-led boom. We're seeing a significant narrowing in the trade deficit. You will start to see more reindustrialization, more building here in the U.S. And those sort of booms tend to be very disinflationary. The yield curve is very flat. The real broad trade-weighted dollar is still at a very high level. Inflation expectations are very well contained. So certainly interest-sensitive activity, which I alluded to, has been soft. That should recover if rates come down, and rates should come down so that the economy could reach its full potential. On the checks, I wouldn't categorize that as stimulus checks. That's money given to hardworking men and women in the armed forces. This was done back in July. This isn't new information. It'll go a long way to helping them deal with cost of living increases.
Okay, so even though it's money given to some households, it is not going to be inflationary at all.
Well, it's money, yes. It is. It's an important amount. It's not an amount that is going to change the inflation dynamic. A bigger number, which is going to impact even a bigger swath of Americans, working class Americans, the no tax on tips and overtime, those are basically supply side initiatives. If you're going to be encouraged to work more overtime, you're working hard for tips, you're going to work more. We have seen labor force participation edge higher. I think it will go up significantly more next year. So again, that's not inflationary. That is more productive capacity, more labor coming into the market. That's what we saw in the first administration, and we should see it again. Supply-side driven growth.
So do you think that there is not any inflationary problems in the economy at this point? I mean, when Americans are facing higher healthcare costs and higher electricity costs and higher insurance costs, is there an inflation problem? Is the Fed too hung up on inflation?
Well, inflation, right now, the inflation rate right now is 2.7. It was a little higher than that the last month that Joe Biden was in office. Inflation, we believe, will go lower. Gasoline and energy, more broadly speaking, Melissa, is a very important disinflationary force because gasoline, energy is used in so many products. There are many second and third order effects. We do expect the inflation rate to move lower. The markets are certainly in agreement with that. As I mentioned, inflation expectations are very stable. We are seeing, if we look at blue-collar wages, non-supervisory production workers through the first 11 months of this year, wages are up 1.6% annualized. That is one of the biggest increases started new administration in decades. So the policies are trying to be designed to raise after-tax incomes, lower the inflation rate, build up productive capacity, and improve living standards. Right now, I'd say the record is very good. Nobody thought that I spoke to, even in the private sector, thought the economy could generate 4% type of growth 2 quarters in a row. And we know from the last CPI, which is November, because the inflation data today are stale, we know from the November inflation data, inflation surprised meaningfully to the downside. So we hope these trends and believe these trends will continue.